So this slide briefly outlines the most basic setup of a portfolio optimization model with only two securities, a bond and a stock. The overall objective is to find the optimal investment portfolio, that is the percentage to be invested in the bond versus the stock, so that the target return is met at the minimum possible risk, which is further sort of described here, right? The decisions variables are those two investment weights, the percentages invested in the bond and the stock. Expected return must meet or exceed the target return, and the objective is to do that at the lowest risk possible. Now, some of the parameters in the data that this depends on is given in the elect6 underscore portfolio file, starting with the pricing data and already calculated monthly returns. So I'm going to show these real quick here. Okay, these are the fake dates, the actual bond price and stock prices, and then the returns that are calculated as the current month's price minus the previous month's price divided by the previous month's price. So this difference between 108 bucks and 110 bucks in relative terms is an increase of 1.2%, and then it's done for all the other guys as well, right? So in switching back to the presentation, the next step is to calculate the annualized expected returns and standard deviations, which are our measure of risk for each bond and stock. Okay, so for each, as well as for the expected returns, right? As well as the covariance between the two. Okay, which is a key piece here. If the covariance is negative, as it will be, because it's traditionally what happens between bond and stock returns, not always, but traditionally, this will mean, or does means or meant, that when the price of the stock goes up, the bond price tends to move in the opposite direction, that is down, and vice versa. This very fact is the basis of the diversification or hedging in the portfolio optimization model. All right, to see how all this works, we'll first switch to the elect6 portfolio and the diversification sheet, and we'll calculate right here in the middle. I'm going to zoom in, move left and right, the correlation between the two set of returns with the CORREL function. Two columns. One is the returns for the bond, of which there's about between 4 and 5 years. I did not mention that, and the stock, which is sort of a traditional number used to get about negative 20% correlation, right? So while negative 20% correlation is not very strong negative correlation, it's significant. And the chart right here of annualized stock and bond returns, the bond is blue, stock is this orange color, generally shows that when the bond prices go up, like here, the stock prices go down. When the bond prices go down, the stock goes up, and then again, when the bond prices go up, the stock prices go down. Okay, which again is the basis of this diversification or the hedging idea, right? Switching back to the presentation, we already mentioned that there will be a target portfolio return or range of returns, and deciding how much invest in each of the two, right, is sort of the key here. Those are the decision variables. The expected return on a portfolio must meet or exceed the target return. That's one of the key constraints, and the objective is to minimize or incur the lowest possible risk as measured by the portfolio standard deviation, which we are yet to describe back here in the diversification sheet of our model. So the first thing we're going to do, or the next thing I should say we're going to do, we're going to calculate the expected returns using the average function on the bond returns, and then we're going to annualize those by multiplying by 12. Okay, so to see the formula, it's right here, average of the D column, and multiplied by 12 to get the monthly returns into the annualized. So this is the bond annualized return of about 3.22%. Copying that to the right gives you a much higher expected return on the stock of almost 15%, which is something you want to see. Okay. On the other hand, the risk of each one of these is measured with the standard deviation functions, STDEV. Okay. Again, same range of cells for the bond returns. Okay, and then this time is multiplied by square root of 12 to annualize it. Not going into this math too much. The variance is multiplied by 12 to annualize. The standard deviations then multiplied by the square root of 12. Doesn't really matter. It's a multiplier giving you less than a 3% standard deviation, annual standard deviation, which is much lower, right? What is it? 3 times, 4 times lower than the standard deviation of the stock, right? So as measure of risk, of course, the stock is more risky, but it does have expected much higher expected return, right? 3 times 5 is 15, 5 times as high, I guess. Okay, next is the covariance between the two is using calculated using COVAR function. Okay, and unlike the correlation, it does have to be annualized. Okay, so first the bond returns, comma, stock returns, and then again multiply by 12 to get again the number. Don't be sort of deceived by the fact that the number is really small. That's simply because the the returns themselves are small numbers. Okay, which is one of the reasons why it's annualized. It's the key piece is that the sign is negative. That's the key piece, right? Just like it is for the correlation. Correlation is a unitless measure between the negative 100% and positive 100%, or negative 1 and positive 1. Okay, so it's easier to interpret and it's used much more than the covariance. But the covariance is needed here because it's, in actual units that a problem is posed in. The target portfolio return is simply 10%. That should have already been in here, but somehow disappeared. We're going to start or continue again by a simple 50-50 split, right? 50% of the money invested in bond and the bond, and 50% in the stock, and we're going to add the two, okay, so that we can assure that 100% is invested at all times. The portfolio expected return is next. It's a simple sum product, a weighted sum, where the weights are the investment weights, 50-50 in this case, and then applied those to the expected returns of 3 and 15% for the bond and the stock, right? So because 50-50 is a simple average, you're going to get something in between 9.10, 10%. For calculating the portfolio standard deviation or variance, which is the square root away, is unfortunately, a little bit more complicated. Although for only two investments, the stock and the bond, it's still relatively simple. Okay, we start with the portfolio variance calculation, and we'll just take a square root of that to get the standard deviation. So, the portfolio variance, starts first by looking at what, proportion or what piece of the overall portfolio risk comes from the individual securities, in this case the bond and the stock, and it's calculated as follows. You take the fund weight and you square it, okay, and then you multiply that by the variance of the bond, which is standard deviation squared. Okay, so that's how much does the bond investment and its individual risk contribute to the overall risk or overall variance of the portfolio. The same, you add that, the same for the stock. So percent invested in stock, or stock weight squared, times the standard deviation of the stock squared, which obviously will contribute much more because it's much higher, these two being the same, at least currently. Next, this is the key piece. We have to now add the third term, which is the interaction or cross product term between the two, and go something like this: 2 times the investment weight for the bond times the investment weight for the stock times the covariance between the two. So this gives you the entire formula. The number 2 here simply means, or comes from the fact that the covariance between the two is symmetrical, right? The covariance is between bond and stock and a bond, so that doesn't really matter that much. The weights are how much emphasis is put on each one of these investments, and then you have the covariance from B7, that tiny number. But no matter how tiny the number is, okay, the fact is that you can see that adding this term is actually going to decrease the overall risk of the portfolio, right? So without this term, the first two terms together will obviously be higher. This is actually reducing it, which is the whole sort of Shangri-La here, right? That is the reason why Markowitz, who is the sort of the inventor, I suppose, of this portfolio optimization, the portfolio modeling theory from University of Chicago, got a Nobel Prize in economics for it, right? So don't forget to take the square root of the whole darn thing by putting SQRT open parentheses in front, close parentheses at the end. I'm going to hit it, get 581. I'm going to zoom in a little bit, hopefully, I guess here, so you can definitely see the cells a little bit better. This is B7 at the end, in case it's not visible. Okay, so now the next thing to do is to create the simple um, solver model for the situation. We want to minimize the green cell here, the portfolio standard deviation, by changing or rebalancing the portfolio or changing the investment weights or fund weights so that in such a way that the portfolio expected return is at least 10%, which currently, as you may see, it is not. Okay, while taking the least risk as possible. In other words, keeping this green cell to its lowest level possible. Like clearly, we're going to have to move some funds out of the bond and into the stock to get to 10%. Okay, and the solver model, right? But the objective again is to minimize the portfolio standard deviation by changing these, investment weights under constraints that the target return, the expected return, has to be at least the target amount, and don't forget to add the sum of weights has to be always equal to 1. Okay, so this will give you exactly how much the shift from bond to stock needs to happen. So it's an 8% shift, give or take, right? 8% less in bond and 8% more in stock will get you to 10% portfolio expected return with the minimal increase in risk for 5.8 to 6.7. Okay, so again, what we're going to do is we're going to just sort of zoom in a little bit and just analyze the couple of charts we have at the bottom left and right side of this sheet. Okay, the chart in the bottom right, I'm sorry, the chart in the first chart, the bottom left, this guy here, okay, shows how the allocation changes as the target portfolio return goes from 5% to 10% to 14%. This is the one that we currently have, 42, 58, 6.7, right? Obviously, at the low levels of expectation for the portfolio return, right, most of the money will be in bonds and a little bit in stock with a relatively low risk. As you increase the target, okay, the shift obviously from the blue to orange happens at sort of increasing rates, where to get the 14% you're going to have almost all the money in the stock versus bond or the highest level of risk. But if you look carefully, you'll notice that the risk as measured by standard deviation does not increase completely linear. There's a little bit of a curvature here, and especially in the bottom left corner, okay, which is more pronounced, a little bit more pronounced here in the chart on the right. That takes a little bit slightly different look. On the horizontal axis, we have the bond weight that changed from 100 to 90 to 80 down to 0. As that happens, obviously the expected return on a portfolio goes up linearly, so, but the portfolio standard deviation does not. Okay, it goes first dips down from 100 down to 90 and then starts increasing, right? The risk increases in a nonlinear fashion. So that's again the key, right? The first step here might sound a little counterintuitive. You would think that with a bond 100%, right, stock 0, this would be the lowest risk, but it actually isn't. Increasing the bond investment, or I should say decreasing the bond investment by 10% to 90 and increasing the stock from 0 to 10% actually lowers the risk. And that's because of that negative correlation covariance that comes into play, right? By slightly increasing the investment in the stock to that 10%, yes, we increase the risk coming from investing in the stock alone, but this low stock investment level, the negative covariance slash correlation, more than offsets or slightly more offsets this increase versus the increase in the overall portfolio risk. This is the key insight provided by Markowitz, for which apparently was worthy of the Nobel Prize in Econ. So I'm going to save that. I'm going to zoom in here so you can see the whole thing. Let's switch to the presentation and pause.